Good afternoon, everyone. My name is Jozef Henriquez. I'm the head of resource mobilization at IDB Invest. I will be moderating a panel today on the financial solutions to attract institutional investors for infrastructure projects in Latin America and the Caribbean. Historically, commercial banks have been more at the forefront of financing infrastructure in Latin America and the Caribbean. But as we've seen, regulations change in terms of capital requirements. We started seeing banks retreating to some of their home markets, tenors shortening, focus on only core clients, which basically has been leaving a bigger gap for infrastructure investments. So naturally, we pivoted to institutions, but particularly as we've seen a wave of downgrades in many of our member countries, it is important to have solutions as well to attract capital to the non-investment grade countries. With me today, we have a very distinguished panel of Nadia Nikolova from Allianz Global Investors and Javier Rodriguez de Colmenares from Santander, who will allow them to introduce themselves before we dive into the questions. Nadia?
Good morning and good afternoon and good evening for those of you who are on my continent. Thank you very much for having me. My name is Nadia Nikolova. I am the lead portfolio manager for development finance here at Allianz Global Investors. We are a 600 million assets under management asset manager. We manage money for Allianz as an insurance company and also third-party clients across a number of investment pillars, one of which is a so-called alternatives pillar where our infrastructure debt investments come in. We have been working together with the, thank you again for having me.
Thank you very much, Nadia. And Javier.
Thank you very much, Joseph. Delighted to be here. You know, this is my second home, as you know. I'm Javier Rodriguez de Colmenares. I'm the global head of what we call in Santander private debt mobilization. So basically responsible on a global basis for distributing, underwriting and distributing in the market what the bank underwrites, not only in infrastructure, but all the asset classes that we originate at the Corporate and Investment Bank. So we are part of Santander Corporate and Investment Banking. I'm based in London. As you know, Santander is a 1.7 trillion euro balance sheet. And, you know, we've been very, very active in mobilizing new money. Corporate and Investment Banking within Santander accounts for roughly 30% of the net profit of the group. And as you know, for Santander, Latin America is a very relevant region. You know, around 40% of our business comes from Latin America. And our core countries are Mexico, Brazil, Chile, Peru, Colombia, Uruguay, and Argentina. We mobilize around 30 billion of the stuff that we originate, 30 billion in the market. Of those 30 billion, around 10 billion is funds that we mobilize in the infrastructure and energy space. Before being the global head of rejoining actually Santander, I was the first division chief of infrastructure and energy at IDB Invest for around 3.5 years. So very much, you know, I said again, great to be here with my friends of IDB Invest.
Great. Thank you very much, Javier. So for full disclosure, Javier already indicated he used to be at IDB Invest. I've known both Javier and Nadia for a while. So we hope this will be a very spirited discussion among friends. And I will start with you, Javier. Now, with your background both in infrastructure and distribution, what have been some of the obstacles that you've seen that prevented greater participation of institutional investors in infrastructure projects in Latin America and the Caribbean?
So I would say that the first thing is the country risk, you know, sovereign risk, you know, and that this is an aspect which, you know, investment grade, it is a relevant aspect. Although more and more we're seeing investors, you know, getting into countries that are not necessarily investment grade, but it's more around there are countries where basically it's a no-go in the infrastructure financing space, where still, you know, there's a lot of political risk. Eventually, The regulation is not yet prepared for the financing, for attracting financing. So the first aspect is the country risk, and there are countries where basically are very well known from investors and happy, very active in those countries. Others where basically we are going to be needing and not only create enhancements, but effectively full guarantees from an NDB or from ECAs and so forth, where you basically have the NDB taking all the risk, and what we will be doing is monetizing that AAA or AA risk in the market, right? So that's the one. In order to avoid the country risk, of course, you can develop the local debt capital markets, but there's a big correlation between development of the country and development of the debt capital markets. So normally, and probably you've heard me saying this many times. I think there's probably nothing more sustainable for financing infrastructure in a country that actually using the savings of that same country to finance the local assets in local currency, right? The second thing, let's say, once we've avoided the country risk, there are some specific obstacles which have to do with is there actually political consensus around PPPs in that particular country, right? So you might have one government that is very inclined towards a PPP program, but then all of a sudden, we change colors and we have a new government that is totally against it, and everything that was done is undone, and actually you have appropriations. And when you have those sort of situations, it is very difficult to get investors back. So the political consensus is very, very relevant. Currency is also an obstacle. So the majority of the investors are looking for hard currency or returns in hard currency. So you can finance in local currency, but then they will need to swap, and the cost of the swap many times it is very expensive. So you are actually asking for a lot of returns on the local asset in local currency to basically get those returns back in hard currency. And I would say that last but not least is around some of the risks that through the contracts and through the local regulations, investors are not willing to take. And eventually there are some risks that they're willing to take in Europe or North America or Australia, because those are markets they know very well and they're willing to take. But eventually there are risks like geological risk or traffic risk or termination payment risk in a concession or in a PPP transaction, that we've seen the evolution in Europe, for instance, of having infrastructure with not necessarily a very clear termination payment scheme. What happens if the concession is early terminated? What happens? Which is a must in emerging markets, and I would say in the case of Latin America and the Caribbean. So, being able to attract money externally means that the country needs to do an effort in making sure that the contract and the regulation is state of the art, making sure that, as the investors get more and more acquainted with the risk of those projects in that particular country, then the country can think about okay, I've done my first 5 transactions. Let's think if I can move towards converging towards a sort of framework similar to what we have in Europe or similar to what you have in Australia. But that's an evolution. You cannot start from emulating what's been done in developed markets, if I put it this way. So that is very specific. I would like to mention as well, and Nadia, of course, can be develop much more on this, but which is, many of these projects are complex, and eventually you can have 3, 4, 5 years of construction period, and that is something institutional investors normally do struggle with. There are some exceptions. Allianz, I think, is one of them, but normally investors are willing to put the capital to work from day one, and not necessarily thinking about deploying capital over a period of 4 or 5 times. So this is an aspect where I think banks should be more and more bridging those construction periods, taking, along with MDBs, taking the construction risk and bridging and making sure that once the infrastructure project has been completed and commissioned, then you have two effects. You no longer have construction risk, so you're only on the operational side of things. And the second thing is that everything is fully funded. So the only thing that you have to do is refinance the bridge, and you can issue a bond or a note that can refinance that on the long term. There are countries where I think commercial banks can take refinancing risk of those bridges, but there are other countries where it's going to be more difficult to basically to ask the commercial banks to take that refinancing risk, and that's where institutions like the IDB basically can help a lot. Can we actually think about some sort of refinancing guarantee or refinancing scheme that will enable us to reduce a refinancing risk and bring institutional investors once the project is fully constructed?
No, thank you, Javier. I mean, that's a great segue, because just this week, actually, our board had approved a transaction in which IDB Invest will be essentially underwriting a full bond and taking that through the construction period. And once the construction period is over, we can then turn around and start selling that bond. To the extent that we can find appetite from institutional investors even before project completion, we will be able to sell it. But the intention was certainly to kind of bridge that gap and take it to the project completion and sell it at that point. Now, Nadia, we have been very successful. We've established a good track record with Allianz in doing transactions in investment grade markets or investment grade transactions. Now, we've been trying to crack the nut on how to do things in non-investment grade markets. How, as an institutional investor, do you see that challenge? What are the mechanisms that you would be looking at to bridge that gap?
Yeah, absolutely. Before I start talking about some of the different methods that we have seen and implemented throughout the years, maybe one thing to say is it wasn't that long ago that institutional investor didn't see infrastructure as an asset class. We are probably one of the largest infrastructure teams, and we have deployed over 20 billion in this asset class today. But we only started in 2012, 2013. And that is in developed markets. So a lot of these concerns that Javier is bringing up, I think more around delayed drawdowns and so on. I think the market is slowly coming also to a place on the institutional side when there is a learning. And it's learning from the large institutional investors that have already built up some experience to smaller now institutional investors that are coming into the asset class. Now we're starting to see the large investors entering not just investment grade, but also in different structures, non-investment grade transactions, but again, enhancing them one way or another to closer to investment grade or investment grade like scenario. So what have we seen? Of course, the MIGA type of structures where we have a sovereign non-honoring type of guarantee that essentially enhances you to a AAA. Are something that has existed in the market for a long time in the banking format. So banks have received AAA guarantees from the likes of MIGA, similar with export credit agencies, and so on and so forth. We're starting to see a whole world of institutional investors come into that space already. IDB also not on the invest side, but IDB has been issuing some of those guarantees in your local regions as well, therefore attracting institutional investors into the non-investment grade markets as well. So that is, of course, one way we have seen. It has scalability. And one of the nice aspects around it is that guarantee, we continue talking in emerging markets about perceived risk and actual risk, where a guarantee very much is able, for investors that are not convinced about that, it puts in a really in nice way, the guarantee essentially gives that gap in perceived and actual risk to the multilateral development bank or the export credit agency, as the case may be. Then the other thing that we have started seeing is structures like the European Investment Bank a few years ago on individual project levels was de-risking essentially transactions under the so-called PBC, Public Bond Credit Enhancement Program, where essentially they were providing a first loss on an individual transaction level in order to boost that to an investment grade rating, to crowd in institutional investors in order to build that that certainty and comfort with investor with the asset class. The reality is we saw a few of those issuances, particularly in Southern Europe, and then the market became comfortable. So the instrument, we see far less of it nowadays because institutional investors don't need it. I keep on bringing you this example from the European markets because I think that can be can have an interesting and good way of transitioning. And then the other thing that we talk a lot, and it was very much discussed during COP26, was blended finance. We have seen models such as the MCPP of the IFC that we participated in a few years ago, where you're essentially building a portfolio of smaller non-investment grade projects with a de-risking at a portfolio level. Now, compared to, that's very similar to that PVC product of the European Investment Bank that I mentioned. But that ability to have a portfolio of projects essentially reduces the amount of first losses needed because by portfolio theory, correlation and diversification allows for less de-risking overall, the likelihood of everything going south at the same time being, of course, lower, the more diversification and lack of correlation you have in your portfolio. So these are some of the four mechanics I think that we are seeing to come in. I think the engagement between the public sector and private sector institutions, development community, and institutional investor has increased. The UN-convened Net Zero Asset Owner Alliance published a paper on scaling blended finance in a way to engage with stakeholders. What do we need to do to be able to scale private capital coming into emerging markets? Because I think it's pretty clear to everyone that if we're going to deal with a climate challenge, the battle is won or lost in emerging markets.
Thank you very much, Nadia. I'm gonna stick with you for a second here because you mentioned something in your intervention right now that piqued my interest, and I've seen you talk about it before in different panels, and you and I have had this conversation, which is the issue of perceived versus real risk. And in our own experience as an MDB, we go into these markets, we structure these projects at a certain degree. It's not like we don't have transactions that will go into defaults or that go through workouts, et cetera. But overall, the performance history of the MDBs have been far better than many commercial banks. So this issue of perceived versus real risk, what has been the view of the institutional market on this point?
Well, the institutional market hasn't really seen that data. And you have heard me talk about the GEMS database, the Global Emerging Markets database, over and over again. There was a publication earlier this year which showed the default rates. And unfortunately, the study showed that default rates were very consistent with the medium risk rating of emerging markets countries. So that wasn't as helpful. I think one of the big things that people who have participated alongside DFI loans know very well is that the recovery rates of development banks are very different, for instance, for equally rated public securities, because of the way you diligence and structure these transactions, the more patient nature of your capital and so on. The recovery rates tend to be to be superior in what I understand most people's experience, but unfortunately that data isn't public. Let me just quickly say why it's important. When we started doing infrastructure debt investments and fundraising outside of the Allianz group, one of the strongest arguments we had in order to crowd an institutional investor was the Moody's database that had the default studies since the 1980s. We could show that the cumulative probability of default for infrastructure projects over a long period of time, but we also could point to high recovery rates. So for investors that were having pressure on yields in sovereign bonds and were looking for long duration, infrastructure was a really helpful asset class in order to substitute some of those sovereign portfolios with still something that is investment grade, longer duration, fixed rate. But also, if it were to go bad, the preservation of capital is very important. These are investors that invest in pension money, life insurance money, so they need to ensure that not only return but preservation of capital is really important. That's why infrastructure as an asset class yields itself very, very nicely to insurance and pension portfolios. But the data needs to be there to be able to show that actually MDB's portfolios have really stuck up in the way that you, in this case, suggest that they do.
Great. No, thank you very much, because it's better when it comes from the market saying that than us tooting our own horn. But we'll toot that horn in terms of performance that we've had in these assets. Going back to Javier. So you had mentioned earlier Miniperm structures, which is something that we've seen very often in the U.S. and the European markets, but to a much more limited extent in the emerging markets. How do you see these types of structures or other mitigating structures developing in the market so you can place these assets with institutional investors?
So Miniperms is basically the structure that we banks invented to basically circumvent all the restrictions that Basel II and Basel III were bringing in terms of allocating capital in the long term, right? So we said, okay, let's do this. Let's do 5-year, 7-year Miniperms, and then normally after construction risk, there's a de-risking of the transaction, and we should be able to either refinance in the banking market that same Miniperm, or ideally, which is what we more and more doing, going to the debt capital markets locally or internationally, right? So I remember this was 2007, just 1 year prior to the global financial crisis, and we actually at Santander structured a $3.5 billion bridge Miniperm, totally in local currency in Mexican pesos. For the acquisition of FARAC, for Red Occidente, Carreteras Occidente was rebranded after that. Acquisition of 4 toll roads in Mexico, which had been, renationalized after the tequila crisis, and they were basically re-privatized after that. And that was a scenario where basically it was actually the first Miniperm, I think, in Mexico. But it was actually 3.5 billion that we underwrote solely, and we had to place that in the market. And the reason why we got comfortable with that was basically because Mexico was already an investment-grade country. Mexico had already a relatively developed the capital markets. You have the Afores, the local pension funds that do actually like the asset class of infrastructure debt for their portfolios. You also have some local insurance companies. So that was the reason why we wanted to do it, and we did it, and then we replicated that with smaller transactions. We've done the same in Chile, and we've done the same in Peru. But there are some other places where it's a little bit more difficult. If you've got a lot of volatility in the interest rate market locally, So you got periods of high inflation, and to combat that high inflation, the central bank is basically hiking interest rates. It gets much more complicated, right? So if you don't have stability interest rates, you have a scenario where you've been doing your modeling with a specific, and you can, of course, run all the sensitivities on interest rates, but you've done it in a period where, let's say, rates are at 4%, and all of a sudden they go to 14%. And it gets to a moment where you have to refinance the bridge, right? And rates at 14%, how can you actually service the debt, right? So those are the situations where I do think, institutions like IDB Invest or BNDES domestically in Brazil, or local development banks that are very, very knowledgeable of infrastructure financing, can actually help in making sure that commercial banks can do that and rely on that refinancing risk, and think about, with the idea of later on bringing the institutional investors or even individual investors, like it's what happens in Brazil. You have the infrastructure debentures, which there's tax-exempt bonds in Brazil. Once it's built and so forth, it's a great opportunity. But you need to get there, right? So sometimes and I really like, the sort of push that IDB Invest has been taking over the last few years, which is actually intervening much more as a catalyst, much more as how can I actually make sure that I can bring more institutional investors and banks and commercial banks into the financing of this specific, rather than just lending into a particular project, right? So I think that is something which can be done from multilaterals, but can also be done from local development banks, right? In those countries where there are already local development banks that work very well and have great stuff and have been investing in infra for many years.
Nadia, you had mentioned, thank you, Javier. You had mentioned earlier that Allianz is a member of the Net Zero Owners Alliance, which leads me to the next topic of climate finance. So how do you see climate change driving the investment decision of institutional investors?
Good question. It's in particularly emerging markets. I think that's where the challenging conversation comes in particular in places where a lot of the economies are carbon heavy and relying on carbon, right? There's significant pledges. I think institutional investors are very much interested in having climate portfolios in emerging markets because they believe in the transitioning of these of these markets. The question there really becomes is how do you finance the transition? Do you only finance the climate projects? One fear we have is with the amount of pledges, both from development community and the private sector that we have, whether we have sufficient number of projects, or what we are going to see is an incredible number of capital chasing a limited number of projects, prices coming down, which is it's great for the borrowers, but is it the best decisions from a risk return profile over the longer term? Is a question. So I think each investor takes their own decisions as to whether they finance the transition or they finance the climate projects, and I think that continues being a debate. There is, however, a significant recognition that there is a social side of the environmental challenge. In particular, in countries where we have a low proportion of the population that has access to electricity, it remains a challenge as to how do we ensure that there is sufficient base load in these markets, in particular in countries where we are maybe transitioning from heavy fossil fuels through transitionary fuels like gas. Are they going to be financed or not in the medium term? that is a question I think that we're all trying to answer. And I think both in the development community and in the institutional community, different parties take a different view on it. So I'll continue being mindful. But I think there is a focus, there is a preference for climate projects, and it will be interesting to see if we have sufficient supply of projects coming through.
Thank you very much, Nadia. Javier, I'm going to throw it a similar question to you because knowing that Santander as well has been positioning itself as a green bank, what has been some of the changes that you've seen in your own investment decision with regards to infrastructure assets in the face of climate change?
Indeed, look, Santander has been for a few years now the largest lender and underwriter in renewables globally, and we take that very, very with a lot of pride. But now it's much more than renewables, right? It's how do we actually make sure that we drive clean tech with sufficient scale, basically to make sure that this energy transition is shortened than with what we are actually targeting, right? So making sure that hydrogen, batteries, and so forth become mainstream. So what we're seeing is more within our bank, of course, but also investors, there are, brown or black assets that they don't want to touch. And sometimes even being very, very dogmatic and around those discussions. And I think, one of the things that we need to think about, I think the NDBs can play a role there in basically in advocacy with governments and multilateral conversations, which is around taxonomies, right? Because if we define the same taxonomy for Europe and for Latin America, that are in different stages of development, then you have a crowd out of investors, for instance, for gas to power, right? Which is, gas is a natural resource which is very relevant in Latin America, and it is a base load source of energy that can be actually relevant in the energy transition, right? So those are aspects that we need to take care about. And I think one of the things working with you guys is actually how can we actually make sure that the public sector, the multilaterals, the blended finance funds, the private philanthropies, and can take basically the uninsurable or non-commercial risks in the clean tech transition, right? We don't know to what extent, how can we actually make scalable a hydrogen project or for buses or for shipping and so forth. So can we actually think about, similar to what Nadia was mentioning, the IB program, can we actually think about, subordinated, working facilities to protect from technological risk, first loss guarantees from multilaterals, bringing blended finance resources, but at a larger scale, right? Not 20 by 20, but eventually thinking about larger projects and larger programs, right, to bring those new technologies in energy. So at the bank, we take this as a very relevant goal for us, to the extent that we have defined ESG and climate and energy transition as one of our 3 strategic pillars in the corporate investment bank. We're working with our clients basically in advising them and financing their own energy transitions and accelerating their energy transition, not only in infra, but in industrial production and so forth. And actually, one of the other 2 strategic pillars is the origin to share goal of using our own balance sheet only, but also attracting and making things bankable with the likes of IDB Invest to make sure that we can mobilize more and more funds around this transition.
Well, I want to thank you both for your interventions as we reach the final minutes of this discussion. I wanted to take some of the points that both of you raised to kind of give you a sense as to where we're heading as an institution ourselves. So as you very well pointed out, Javier, the role of the MDB is changing. It used to be one of, we go in, we structure the transaction, we invest in it, we put it on our balance sheet, and we manage it for the next 20 years and we forget about it. I think more and more the role of the MDB is becoming one that is originating the asset, de-risk it, and place it with institutional investors. And you're going to start seeing more and more churning of our own capital as we start looking at deals that we say, this doesn't have to be on our balance sheet for the next 20 years. Once it reaches project completion, it's something that we can place in the institutional market. And then also a matter of, de-risking has come up a number of times in this discussion. What is our role in de-risking? Our role of teaming up with blended finance donors and bringing in those funds to de-risk these transactions, either on an individual basis or on a pool basis. And then much more importantly is the part of creating the right frameworks, creating the right business environment in the PPP structure, because one area that we didn't touch much upon in the PPP is the public side. Unfortunately, Gabriel Galípolo, who was supposed to join us for this discussion, had an emergency come up, and we couldn't address that part. But certainly, being part of the IDB group, where we have our specialists that work with the sovereign partners in structuring PPP and also on the IDB Invest side, but creating the right business environment to lead us into a situation where we can bring more institutional investors, attract more capital to the Latin American Caribbean. Thank you very much, Javier and Nadia, for your intervention, and I'll pass it back to our organizers.
Thank you. Bye-bye.
Thank you very much.
Cheers.
Thanks, right.